Today, we're digging into an analysis you shared with me that's, well, it's incredibly timely. It's all about a huge pharmaceutical company, Novo Nordisk, that seems to be caught in this really strange market paradox.
It is, and the whole argument of the report, it really starts with this wild premise. The idea that the most important weight loss company on the planet is, and this is their phrase, on sale for 50% off F.
Exactly. Which sounds almost too good to be true. So our mission for this deep dive is to figure out if this massive drop in Novo Nordisk, ticker NVO, really is the single best buying opportunity we might see, especially looking out towards 2026.
And the numbers really set the stage. I mean, this is a stock that was up near $100 a share back in 2024.
And now it's sitting around 50. But here's the kicker the report focuses on. At $50, you're looking at a PE ratio of just 13.8, and it's throwing off a 3.39% dividend yield. Okay, let's unpack this.
It's just a shocking contrast, isn't it? You have the leader in what could be a multi-trillion-dollar market.
A leader they basically created.
Right. And it's being valued like a slow, boring utility company. So to understand that, we have to start with the fear. Why did the market just slash this company's valuation in half?
Yeah, you have to address that first. The drop from 93 down to 50. The analysis is pretty clear that the market basically decided Novo's explosive growth era was just over.
And it wasn't just one thing. It was sort of a perfect storm of three specific fears hitting all at once. The first one, and probably the biggest driver, was real competition finally showing up.
Eli Lilly.
Exactly. Eli Lilly with their drug Zepbound, investors just got spooked that Lilly was going to come in and just eat their lunch, take huge market share.
That's a classic market overreaction, though, isn't it?
Yeah.
The incumbent always gets punished when a strong number two arrives.
It is, but the fear was very real. And then on top of that, you had the second problem, which was really an execution issue on Novo's part.
The supply constraints.
Yes. They simply could not make enough Wegovy to meet the unbelievable global demand all through 2025.
Which is so frustrating for an investor. You have the golden goose, but you can't get the eggs out fast enough. It creates a bottleneck that Wall Street just hates.
It punishes it immediately. And then the third fear, which is always lurking for Big Pharma, was the government. The concern that the U.S. government might step in and force them to make drastic price cuts.
So you combine those three: new competition, can't make enough product, and political pressure. And you can see why maybe a generalist investor would just hit the sell button and run.
And that's the core of the bull case from the report, that this is a massive, massive overcorrection. The market, it often overshoots on bad news, especially for these high-growth stocks where the expectations are just through the roof.
So that brings us to the comeback story. The analysis pivots hard here and says the market is just dead wrong, that this is smart money quietly buying up shares, seeing 2026 as the big comeback year.
And it's not just based on hope. The argument is built on two very specific, very real catalysts that are coming down the pipeline.
Okay, let's start with catalyst number one. The report calls it the golden pill revolution. We're talking about an oral pill version of Wegovy.
Yes, scheduled for 2026. And this isn't just a small update. They call it a game changer for a reason.
Because of the needles.
It's all about the needles. I mean, that is the single biggest barrier for millions of people. They want the results, but they will not self-inject every week, taking that away.
It just opens up the market to almost everyone who's ever wanted to lose weight.
A massive new market. The report suggests this alone could kick revenue growth right back into the double digits. It kind of neutralizes that fear of competition from Lilly because you're fundamentally expanding the entire pie.
That makes so much sense. You're not just fighting for existing patients, you're creating millions of new ones. Okay, so that's convenience. What about the second catalyst?
The second one is all about pure performance, pure efficacy. It's a new drug in their pipeline called CagriSema.
And this is the one the report labels the super drug.
A bold name, yeah, but the early data is pretty stunning. It's a combination drug, and the initial results are coming in better than anything else on the market.
Here's where it gets really interesting. The early data they cite shows CagriSema delivering around 25% average weight loss in trials.
And to put that in context for you, 25% is higher than the incredible results people are getting from Zepbound.
So they're not just trying to match the competition, they're trying to leapfrog them.
That's the idea. If the official data, which is coming later this year, confirms that superiority, the analysis sees that as a major trigger for the stock. It just completely flips the narrative.
Okay, so that's the growth story, a huge pipeline. But now we have to tie that back to the price, back to the $50 stock. This brings us to the financial argument, why the report says this is such incredible value.
Right, because if you believe those catalysts are real, then you're essentially buying a high-growth tech company that's been mispriced as a dying value stock. And you see it when you compare it to its main rival.
Let's lay it out. Eli Lilly, LLY, is trading at a PE ratio of about
50, right. Roughly 50 times earnings, yes. A huge multiple that implies years and years of massive growth ahead.
And then you look at Novo Nordisk, NVO, the company that started it all, with these two monster catalysts on the way.
And it's trading at a PE of 13.8, just 13.8. The market is pricing it as if it's going to stand still for the next 5 years.
It's trading like a boring utility stock, as the report says. The whole idea is that that gap, that huge valuation gap, has to close once these catalysts start to hit in 2026.
And while you're waiting for that to happen, you get what the analysis calls the dividend bonus. That 3.39% yield is very attractive.
And it's safe, which is key. The payout ratio is only about 50% of their earnings. This isn't some risky yield trap.
Not at all. And if we connect this to the bigger picture, you have to remember that NVO is a cash printing machine. We're talking about $9 billion in free cash flow. This is a profitable, stable giant that has the money to fund the rollout of these new drugs.
That's such a crucial point. So we've got the fundamentals, we've got the growth story. But for anyone thinking of buying this dip, the big question is, where's the bottom? What does the technical analysis say?
The charting side of the report is actually pretty comforting. It points to $50 as a massive historical support level.
Meaning that in the past, whenever the stock gotten this cheap, big buyers have always stepped in.
They've stepped in aggressively, yeah. And right now, the chart is forming what's called a double bottom. It's a classic bullish signal that suggests the selling is exhausted and a reversal is likely. It really points to $50 being a solid floor.
Okay, so that's the floor. What about the ceiling? What are the price targets?
The first, more conservative target is $60. That gets it back to its 200-day moving average, which is a key technical sign of health.
And the dream target?
The dream target, which the analysis says is very possible by the end of 2026, is $70 to $75. But that is entirely dependent on a successful launch of that oral pill.
Of course, there's always a risk. What's the main thing that could derail this whole bull case?
The big one is if Eli Lilly just completely dominates. If they somehow manage to capture, say, 80% of the entire market, leaving Novo as a small secondary player. The CagriSema data makes that seem unlikely, but it's the primary risk you have to watch.
So wrapping up the verdict from the report, it seems to be that at $50, the risk-reward is just incredibly skewed to the upside. It's a classic buy-the-fear situation.
It's a bet on execution. If Novo delivers on this pipeline, the market will have no choice but to re-rate the stock much, much higher to be in line with its peers.
So what does this all mean? When you put it all together, the analysis is painting a picture of a double win. You get in at a very cheap price, you get paid a nice dividend while you wait.
And you have these two enormous catalysts on the horizon that could completely change the story and close that massive valuation gap with Eli Lilly.
And that brings us to a final provocative thought from all this. The whole bull case seems to pivot so heavily on the success of that oral pill. So if it works, if the pill becomes the new standard for this kind of treatment AZ, no needles, high compliance.
It changes everything.
It does. You have to wonder what that means for the entire pharmaceutical industry. Does the success of an oral version of a drug like this, does it basically make the entire market for regular injectable drugs for chronic conditions obsolete, or at least less valuable?
That is the multi-trillion-dollar question, isn't it? If Novo proves you can get the same or better results from a simple pill, it could force a fundamental change in how drugs are delivered across the entire industry. Every company relying on injectables would suddenly be on the back foot.
A huge potential shift. It's definitely something for you to think about as we see how this all plays out. Thanks for joining us.